Hey, everybody. Welcome back to 21st Century Renaissance, and welcome back to another Open Interest newsletter breakdown. I'm your host, Dr. Mike LoPiano. Wonderful to see you all once again. Here we are on Monday. Here we have another market panic like we saw last week on Monday, right? Last week, Monday, it was DeepSeek, right? Of course, this is coming amid the Bank of Japan rate hike. Was this really Chinese AI related, or did this have to do with something along the lines of rotating out of certain positions because of Bank of Japan? I certainly don't know, not privy to the data to be able to say at this point. Today, right, okay, we look at, interestingly, we'll take a look at this in a sec, but the exact same move in the broader market, but now it's tariffs, right? So something clearly going on here. I'm curious myself the degree to which this is maybe just something related to tech earnings, and there are excuses to sell the news, something like that. I won't speculate too much on this, right? Because this isn't the data that I necessarily look at, and then that we talk about here on with the Open Interest newsletter. But suffice to say, it's going to frame a lot of our discussion today. So we'll be taking a look at that. For those of you who may be joining us for the first time, every day prior to market open, I post analytics specifically pointed towards GameStop and understanding, forecasting its price movement, understanding how its price has moved in the past, and how we can use this information to anticipate how it may move in the future, primarily through a technical and options analytics methodology. So this is available on my X page every day before market open. If you're viewing this on YouTube, you can find it linked down in the description of this video. If you're viewing this on X, of course, it is pinned to the top of my page. So yeah, so let's hop into this stuff for today, right? Obviously, gotta play it up a little bit with the tariff theme. Yeah, that's the word on everybody's lips here. Let me go ahead and say thank you, of course, first and foremost to Goat Zubak for treating me to coffee today. Thank you so much for sponsoring today's newsletter and today's video, as well as to Dat Scruffdo. Scruffy, thank you as always for your support, and thank you to everyone who has supported me in the past or has a shout out coming up in the near future. You help me keep this monetized and keep this available and open to everyone for free. Thank you so much. I really appreciate it. What exactly is going on here? Is this a genuine market reaction to macroeconomic conditions that are now going to be brought about by tariffs? Not sure. We'll have to see. Just like last week, I suppose there is some chance that there is continued downside potential. We'll take a look at our broader market context options data to see how fast something like that would materialize. There is a question as to how much of this is still deleveraging the yen carry trade. How much of this still has to do with big tech earnings, right? The S&P 500, the NASDAQ, these big index funds are heavily weighted toward tech. So to see this kind of volatility around tech earnings is perhaps not a surprise in that regard. Although things like DeepSeek or tariffs may be what actually makes the headlines, pertinent to their political dynamics. But if we take a look at our context, and this is something that always, when I see this, it makes me question just how much this is, right? There's an idea that, at one point, right, the whole sell the news thing made sense from the perspective that what moves the price around is authentic supply and demand. Oh, a headline comes out, people are uncertain, and so they want to exit their positions. There's broad selling that occurs because people are uncertain about the news headline, and this can cause a dip, and this can cause a run, and things like that. But of course, what's so suspicious about this is the degree to which these dips occur when no one can trade, right? That this is only major institutions who can really move the price at some of these key moments in time, and that certain headlines, differing headlines, somehow cause the exact same movements in the major indices. So, right, what we saw here with the DeepSeek fake, this DeepSeek dip, which immediately, within the course of 4 trading days, completely corrected, right? So we went to all-time highs in SPY, the S&P 500, and then down to 89 level in SPY, just a little bit above 589, I think about 589.75. In the pre-market period, most of this occurred, right? We had a gap down, and then most of this occurred in the overnight window into pre-market trading, and then buy up from the S&P 500 SPY's put wall, which is this composite level down around 589, 590. This sort of big outstanding, put gamma dominant position, moved down here, and then it bounced up, and then as I mentioned, right, back prior to market open on this sort of this DeepSeek Monday, that what I thought would occur is because of the magnitude of this move occurring when options could not be traded, that what would happen was as soon as this opened up, you would see traders rush to close their puts, right? Puts that were opened in here during this downtrend. They would rush to close their puts that they had opened in the short term here. We saw a lot of puts get opened late this Friday prior to the DeepSeek dip. We saw the same exact pattern, actually kind of a deeper pattern occur here toward, when this, right around the time that this tariff headline came out. And what did we see? We saw a very similar move, though with a bigger gap, right? Trading into the hours down flat period here. But so where did we go? We went to about the same level. So 589.75 with a DeepSeek dip, and now 589.02 before recovery started to occur. So, a lot of these puts were entered in very late in the day. Our position, this was our this sort of composite put wall position with a amount of neutral gamma below it. Look down at put flows, right? They picked up right around time that this amount being traded. Came down a little bit here, but was pretty flat through most of the day. And then when put flows started to pick up, then of course, right, traders exited calls that they had entered into earlier today. Put flows picked up and up down with it. So a lot of these had to do with very short expiries. So this type of move that we saw last Monday, certainly what seems to have been the case, was the result, yes, of traders closing puts. So this type of move is on the table again, and what we saw last Monday was a return up to right on the border of our volatility trigger. So right, I don't know, around 600, around the 600 level, which means that as long as it stays below that 600 level, we're going to be in, right, Spot Gamma points this out, something called risk on condition. So, right, there's risk of, all right, well, we can just kind of take it, the price can be taken by put flows very, very dramatically, sort of back down the ladder. We can see intraday swings pretty wild, right? Rather than kind of get this very sort of sideways or kind of upward grindiness pattern, instead we can see something kind of scrub up and down pretty violently within the day. If this is indeed something that just has to do with tech earnings and it doesn't have to do with serious macroeconomic concerns, then the thought there is that then once these earnings kind of pass, then we'll move back into more stable trading conditions, and then maybe try again for another all-time high once tech earnings season is passed. Right? I don't really know what's causing this underlying weakness, but whether it is genuine macroeconomic concerns or whether it's just tech earnings or whether it's rotating out of the yen carry trade, very hard to say. Not privy to that data. I won't try to speculate. What I will say is just reiterating that most of our price action at this point in GameStop, because we're at the bottom of this volatility cycle, where we're not really seeing material changes in the underlying stock. Everyone's kind of sitting around waiting for Ryan Cohen. That seems to be the case for Roaring Kitty as well. His last meme seems to suggest that he's sitting around waiting on Ryan Cohen. At this point, where GME is priced wise, I mean, yes, of course, right? There is authentic kind of buy demand, sure, that likely has been packaged away in swaps or moved into synthetic positions and things like this. And of course, the price is manipulated. But right, what really will push for price discovery at this point, greater price discovery, is material changes in the underlying company. That's right. What drove this particular trend were material changes in the company, which occurred over the summer, followed by a cool-off period, and then institutions, what looks to have been the case was institutions then rebalancing their portfolios based on the fact that GameStop had issued about 40% more shares, and the inflow of cash had materially changed the fundamentals of the company. But we really haven't seen much. I mean, earnings have been good. The earnings periods we've seen for the Q2 report and the Q3 report have been very promising toward the end of 2024, insofar as they suggest that, hey, if Q4 comes in and it's pretty good, GameStop is going to be showing some pretty cool earnings growth. And that seems to be what fundamentally buyers are waiting on at this point. What earnings growth might be expected may have been priced in up to a point, or is over these price levels may already be priced in to a certain extent. So whether or not Ryan Cohen can deliver on that is likely the question mark that is holding back a return to more bullish conditions. Something like that, right? We don't necessarily have another catalyst in the short term to suggest that there would be some sort of disruption to these types of volatility cycles that we're seeing. So basically, even yesterday, right, during the trade trading yesterday, we mostly stuck to within. Let me put it large for us. There we go. Yeah, right. So we stuck largely to this this range-bound sub-channel within this broader bearish regression channel, as we had for about 2 weeks. Right. This also ended up flattening our bearish regression channel to a good degree. All right, kind of just dipping out of it a little bit, but basically staying within the basically all throughout the day up until about 1:30, traded within the upper half of this channel, and then traded down to the lower half as a result of this. Probably ETFs rebalancing with SPY dipping late in the day, giving up so much value as a result of this, ostensibly because of the tariff announcement. Yeah, and then right, gap down 3 minutes, only on 10,000 reported volume. Of course, the real volume is probably a lot higher. It's not actually reported to the major exchanges until until the pre-market period by Blue Ocean. So gap down in about 3 minutes, not actually necessarily a gap down, actual traded down on ostensibly about 10,000 volume over about 3 minutes, down to 2450, right, almost reaching the lower bound, not quite reaching the lower bound of the bearish regression channel here, and then moving back very quickly up over 25, down a little bit, and then returning back to the midline of this channel by the pre-market trading hours. So what does this say? Well, unfortunately, it does somewhat foil the validity of this sub-regression channel here as a meaningful technical paradigm within these several weeks. It does reassert, even if artificiated, it does reassert the predictive structure of this bearish regression channel, and does explore this kind of 24 area, mid 24s deep support heading forward. There's not much to say at this point in terms of whether this means we immediately go down, or this means what seems to be suggested here is there's just not a lot of, there's not significant trade volume, let's say, either through retail or institutional sentiment at this point, in waiting for Ryan Cohen, in waiting for an earnings debut, something like that, in waiting for a report of revenue growth. And with the market showing general weakness, showing these episodes of really quick, sharp correction to the downside, there is vulnerability, right? As we've seen in these volatility cycles, when this occurs, GameStop is vulnerable to manipulation by institutions during overnight periods. Now we have these overnight periods, right? New opportunities to really mess with the price, and that will continue to be the case. There will be that potential for weakness, so long as there is weakness in the broader market. GameStop has a tendency, we've talked about this before, GameStop has a tendency to show high correlation with downturns in the broader market. Not necessarily with upturns in the broader market, although that does sort of set the stage for more potential consolidatory activity. I will say from our option structure, it does not look presently like we are like a test of this lower area is necessarily inbound again. If SPY, well, it's not super helpful to say, right? Like if SPY does continue to move to the downside, GameStop will probably move down with it. If it does not, then the downside is likely limited. At this point, it's sort of, this is it can be a frustrating situation where it's just kind of, the stock is at the mercy to be moved around, by people who pull the strings on these market corrections too, right? These aren't happening because of, at 8 p.m. on a Sunday night, right? Retail traders are sitting and waiting and going, I can't wait to liquidate $1 trillion of my position in my index funds, right? Because of that, because Trump said something about tariffs on Friday. There are other factors at play with the major institutions that control this, right? So does look like, right, this was certainly a good sign as far as, right, we did not necessarily, this wasn't an uncontrolled free fall down to say 22. We have a deeper support down at $22 over on our weekly chart. We do have some separation from the weekly moving average, right? The 200-week moving average. We do have some separation now from that weekly RSI trend line. Be interesting to see if that can be reclaimed. Yeah, so, for now, maybe looking at, I would say probably the most key technical level at this point would be to see how we behave with respect to the 100. This would be the 100-day moving average, which is right around where we've been kind of hovering in the pre-market period. Right, our options landscape continues to project that, okay, we're probably going to hang out in the 26, 27s. Maybe we go down test 25 a bit, something like that. Sort of sitting in the lower half of this $25 to $30 macro bracket. What I will say is, and what I would recommend that you go check out, right? I'm certainly not an expert on this, but Richard Newton has been writing, has been speaking quite a lot over the past few weeks about the potential for this kind of continued bearish momentum into and maybe aiming for these particular swap roll dates that go back to, say, 2021 and even before 2021. He had pinned January 27th as a potential date, so interesting to see that deep dip last Monday play out. Interesting to see a lower low finally materialize going into today's trading. We'll see how well that sticks around, but yeah, this could certainly dip lower if we continue to get bearish market conditions, and it may just be that there aren't major retracements to the upside until we get until that kind of what would you say, until the IV appreciative period in the 2 weeks prior to GameStop's annual earnings report, Q4 earnings report. It may not be then that price discovery really occurs until then, after the publication of especially of revenue numbers. That's kind of the last thing that's standing in the way to, hey, is this really going to be a growth stock? And the general institutional sentiment is no until proven wrong, right? That's kind of that's an annoying place to be in, right? It seems like some stocks are the inverse, right? Yes until proven wrong, and then maybe a little bit afterwards, right? GameStop seems to be to have an inverse relationship of no until proven wrong. So I definitely check out, continue to check out and keep pace with what Richard Newton's working on here. Options changes. I will say that, no one in the options market was really betting on a dip to 24.40. We just didn't have OI accumulate down in this area, really across any of our strikes. The lowest we got anything was down around 25, which in the short term, right, does look like a downside support, right? There just hadn't been that much OI down there. That does seem to be the case. Interestingly, we did get some mixed sentiment in our kind of upper valued strikes here. 28 and 29, very heavily biased toward trades at the bid. So those were, some traders did come in, whether this was traders or institutions, sold quite a lot of short calls late in the day. So rather than going for long puts in major numbers, going for these close to the money or at the money short call positions opened into this Friday's expiry. What was very interesting too is our short put trader or traders or whoever this was decided to come back and open up that same 26.50 short put trade. So basically there was no OI at this strike, right? It looks like this trader maybe on Friday either rolled this entire position or opened up a new position. This is not into this Friday, but the subsequent Friday. So depending on the strength of our recovery, if we get traders closing like a lot of these long puts here, if we get this recovery like we got last Monday with SPY also recovering to the upside, this 26.50 position will serve as a bit of an overhead resistance if the recovery via traders closing puts and sort of there being a broader market recovery does occur. This will be less of an issue, right? This will put less meaningful downward pressure. It is still a pretty small position at 26.50, right? There's still some, right? We don't even have that much. We have some at this position heading into this Friday, but otherwise, right? If we don't and we kind of go to flat conditions here in like the 25 to 26.50 range, it could set itself up as a resistance level, based off of gamma hedging. So right, we can see that right early in the day this was entered. So this trade's down a little bit. Max Payne, right, still at 27, and see that's the other thing too, right? Options did not move too much just based on Friday, right? So much of this move that took place, right, this downside move from the high on Friday to the low in the overnight period, Sunday into today, right? That's something like over it's like a $3.50 move, but of course $2.50 of that move was processed during the overnight period. So options market not really in a position to react to this since this is occurring when you can't trade options. Very interesting to see, to observe how this is going. I think even more calls are out of the money now, but we're still looking at max Payne values in the 27s. February OPEX is the 26, so maybe this is it around 26? So maybe this is a way to kind of this sort of lower range, closer to 25. still heartening in terms to see these types of movements, to see something, right? It's not like we're seeing this complete price collapse back to $20 or $19. It's still taking time and effort in terms of whatever bearish institutions are trying to do, whether they're trying to walk the price down because of swap rolling, or whether they're trying to package this down in order to maximally benefit options trades on this type of volatility cycle. Some combination of the two. It's still taking more time. It's not like 2021 where you see the price go down hundreds of dollars a day. Yeah. So just to put this out there, right? We have in our gamma exposure data, right? We can see this reminder that this position is still short, but right where we have our OI and where we have our gamma exposure is mostly concentrated here, 27, because of the number of short puts that they're serving as a potential overhead sort of lid on our trading if we don't get a strong recovery back into that area. IV, interestingly, moving down to, really almost there, almost to that depth of low IV valuation down toward late October. We're down around the values we saw late August, little bit above there, right? So I think 10-day mean implied volatility right now is around 49%. Back late August, it got down to 43, and late October, it got down to 40 or 39 and a half, something like that. So yeah, until we get a big recovery to the upside, like a big recovery to the upside, until we get some sort of catalyst, until we get a kind of earnings thing, right? Then implied volatility kind of returns to here. And then, it may even look something like last February, right? February 2024, we were just kind of sitting on this low IV bottom. It was actually a bit higher than we are right now. Is it around 55? We kind of oscillate between 55% and 60% 10-day mean implied volatility, and then kind of only spike for earnings. We saw that a lot in 2023. That was basically like all of 2023. We had IV down in those levels, except for earnings period. So okay, we're heading back there. Probably, like I said, another 2 weeks until we touch that true bottom there in October. If we continue to see the types of volume numbers that we've been seeing over the past, certainly last week down in the 3 millions, maybe we start logging 2 millions, right? We'll see something like that. And then, right, maybe in February, maybe not something full blown, right? Not a big IV move back to the upside until around March 11th. And again, Richard Newton points to March 11th as a big swap roll date. The other one being the 28th. What's very interesting about that is that kind of frames that earnings appreciation cycle, the 2-week cycle leading up to earnings, and then the kind of cool off for the sharp cool off the 3 days after earnings, pretty much perfectly. So be interesting to see what that looks like. We might have something of a kind of a moderate sort of snapback, something like September 20th. So I want to point this out, right? Back in September, right after earnings, we had this huge 61 million volume day on September 20th that greatly affected IV after earnings, right? So that would have been right here, right? So earnings came almost all the way back down, and then we had a price pop up decently by a few dollars off that $19 bottom. IV stayed up, and then that sort of traded off and down to the lows through the latter part of September and most of October. We could see something like that, right? So the anticipation there is that looked like the closing of ETF FTD positions on GameStop. That was that would be the up move that would signal the end of a certain volatility cycle, followed by shorting and entering back into it. So that September 20th portion there looked to be something like the midpoint between two volatility cycles. So something like one that reached its bottom around the Nikkei crash, maybe something like that, slightly after, right? It sort of began around, August 2nd to August 5th. Perhaps even maybe a little bit later. No, that would shake out in terms of how that cycle usually plays out. And then, right, that played out down to low volatility shortly before earnings. We had the 2-week earnings kick up in implied volatility, the crush for the 3 days afterwards. And then we popped up a bit as the up move, right, closing those early August FTDs, right? So you're not going to close them when the price is up here. Part of perhaps why they weren't closed when the price was up here was because we got these, maybe they started to be closed on the, 27th would have been early to start closing those, 28th. But certainly something like, that cycle may have been interrupted by Roaring Kitty's tweet on September 6th. But in any case, right, this was sort of postponed until after the IV crush, that IV cool off, and then toward the end of that week, right, September 20th, big up move, huge IV spike, 61 million volume, and then enter into shorting afterwards into another bottom. And then the next cycle to occur was what happened after October 28th, 29th, and then into this big uptrend, and the many factors that brought this about. So we might see something in here. I have to take a look and take a look at these windows, otherwise category 42's windows, take a look at his formula, what he calls his boofing formula. To take a look at this, Richard Newton's also done some good work with his spreadsheet in particular, kind of working in this formula and testing this formula from otherwise category 42. So looking at this and trying to say, okay, well, when are all those FTDs maybe from January 14th? Those would probably be due sometime around February OPEX, right? The maximum extent to which those can be due would be after February OPEX, depending on holiday exemptions. When would those come due? Because we haven't really had too much of a recovery since then. We haven't seen a huge price recovery since then, with the exception perhaps of Roaring Kitty's "I will wait for you" Futurama tweet here. That did look like it ate up a chunk of short liquidity when that occurred, several 100,000 shares. So something like that, maybe not something quite as full blown as an earnings-based IV pickup again. I don't think we're going to see something like that until March. I would not expect that to occur until around the 11th or the 12th of March. But to see us kind of grind down for another 2 weeks, then we should have institutional filings. We're starting to see institutional filings trickle in. They're due, I believe, the 14th of February. Maybe we have something like an up move either that weekend or the following weekend, into February OPEX, maybe just before February OPEX, maybe on February OPEX. Hard to say. I won't speculate too much at this point, but maybe something like that kind of a kickback and enter into another volatility cycle, and then await the results of March OPEX and wait the results of our annual report. So that's it. That's that for me today. Definitely, be monitoring the situation, taking a look at this going forward. Certainly in terms of long-term indicators, excellent to see price action still consolidate early. I mean, above 25 heading into February. It can be tough, right? It can be tough to wait for these catalysts, wait for actual material change in the company. I know a lot of people are impatient with respect to Ryan Cohen, but as Roaring Kitty said last summer, right? This is and has always been right a bet on Ryan Cohen himself and what he can do as far as moving forward with company transformation. And Ryan Kitty reiterated that at his live stream last June, as far as this still being a bet on Ryan Cohen and say looking at what the next 3 to 5 years can bring and sort of what earnings will mean for that. And certainly there's a lot to look forward to as far as March earnings. Maybe a little some patience is required ahead of then. Comparatively more patience if we have a downturn in the overall market, but we'll be here every step of the way to see what we can see and see what we can discern. And we'll just have to see what the future brings. So thank you very much, everyone. Look forward to seeing you all tomorrow. Good luck out there with your trades, with your investment decisions. And we'll catch you next time. Thanks very much. Take care.